And Iran hit back after Israel's attack on military and nuclear-related targets. We are now witnessing what threatens to become a full-blown conflict. And there have been attacks on energy facilities in both Iran and Israel. Our guest says if strikes on oil infrastructure continue, we can expect oil prices to rally $5 a barrel. And both WTI and Brent have a strong chance of hitting $80 US. We're joined by Andrew Lipow, president of Lipow Oil Associates. Andrew, thank you very much indeed for joining us. I know it's a rapidly changing situation. RBC's take yesterday was that so far neither side has targeted major energy export infrastructure, but maybe you can clarify that.
Well, good morning, Andrew, and thanks for having me. What RBC says is quite true. If we look back at what's going on in the Middle East today, in spite of the hostilities between Iran and Israel that we've seen over the years, this is really the first time that we've seen oil and gas production facilities as well as refined product depots actually being targeted and impacted. Mm-hmm. In fact, Israel had launched missiles against Iran's South Pars natural gas field. So we do know that there's some impacts in that energy space. What the market is now looking at is, will there going to be impacts on oil production facilities as well as oil export facilities that might lead Iran to cause a potential supply disruption by attacking either tankers in the Strait of Hormuz or actually attempting to shut the strait down?
There's talk that Israel's real goal is the so-called regime change in Tehran. And of course, if the powers that be in Tehran feel they're actually under threat that way, they could be tempted to escalate.
Well, certainly the people of Iran are really being choked by the regime that is controlling the country. What we don't know is if the regime feels so threatened, number one, is what would replace them if the current regime was taken out? But number two is if they are backed into a corner, mm-hmm. would they feel that they have nothing to lose by attacking either their neighbors' production facilities, or shutting down the strait in order to inflict maximum economic pain on the consumer through rising oil prices, which would certainly exceed $100 a barrel.
And there's speculation that maybe they'll get their proxies in places like Iraq to attack oil production. I mean, they have militias, et cetera, in lots of countries.
Well, that certainly could be the case, but Israel has actually done a good job in attempting to neutralize the Houthis, Hamas, and Hezbollah, which are Iranian proxies that have been attacking Israel over the last couple of months.
What? At this stage, I know, Andrew, it's very hard to read, but would you anticipate higher oil prices amid this conflict?
I think that the longer the conflict continues, higher oil prices are in the cards, mm-hmm. because we don't exactly know what type of Iranian retaliation is going to be, given, whether it's against continuing Israeli targets, or are they going to draw American targets into the mix, as well as attacking shipping. And as I mentioned, shipping through the Strait of Hormuz is really a soft target that could significantly impact the world economy, as mm-hmm. well as politics in the United States on rising gasoline and diesel prices.
But it would be tricky, though. Apparently, physically closing that strait for a long time would be very tricky. And of course, the U.S. Navy could be expected to respond aggressively.
Well, there's no doubt about that happening, but I think the issue is, could the U.S. Navy protect every single tanker or vessel that's transiting the strait? Mm-hmm. And this is happening at the same time that vessel owners are going to become more reluctant about sending their vessels through the strait, and we're already seeing that in higher tanker freight and tanker insurance costs. It
is fascinating. I mean, this feels like a new stage of violence between Iran and Israel. I mean, I don't think we've seen anything like this in years, this level of attacks.
Well, I agree. This time it does feel different, especially whether Iran feels that Israel is trying to attempt regime change or Israel is denying that they're attempting regime change. The tensions in the region are certainly elevated compared to what we've seen in the past when attacks between Israel and Iran lasted a day or two. This type of cross-country attacks is continuing into day number 4.
And you, in your analysis, you're pointing to LNG. It's kind of, we talk a lot about oil, but natural gas. Israel, as you mentioned, has attacked that Iranian gas field. We could see disruption to the global liquefied natural gas market.
Well, that's right. The South Pars gas field is an extensive field that extends beneath both Iran and Qatar. When we think about the Strait of Hormuz, it affects exports out of Kuwait, Saudi Arabia, Bahrain, Iran, as well as Qatar. And Qatar is a major exporter of LNG of over 10 billion cubic feet a day. They're kind of very close with Australia as number 2 exporter behind the United States.
Andrew, leave us with a final thought. Obviously, the oil price, let's have another look at a 5-year oil price chart. There have been concerns about a global slowdown and excess supply in the market with OPEC+. We could see a volatile summer for oil. I know that's a rather bland statement, but it looks like we could see some pretty big price swings.
Well, I think that's right. But the good news for the consumer is that OPEC Plus has been restoring their voluntary production cuts that they implemented several years ago. And between April and July, they will have restored about 1.4 million barrels a day of those production cuts, which is actually nearly equal to the amount of oil that Iran is exporting, which is about 1.6 million barrels a day. So the loss of Iranian oil exports could be made up by continued restoration of these voluntary production cuts, as well as the release of strategic stocks, if necessary, both in the European Union and the United States.